Welcome to TalkTickers. We dive deep into earnings calls, extracting the critical insights you need as an experienced investor.
And today, we're digging into the Everest Group Limited first quarter 2025 earnings call. Quite a bit to unpack there.
Definitely. Let's start with the headline numbers. So they reported operating income of $276 million.
Right, which is pretty solid considering the significant catastrophe losses hitting the industry in Q1.
Yeah, those cats really impacted the combined ratio. It came in at 102.7%.
And a huge chunk of that, 13.9 points, was from catastrophes, mainly the California wildfires, it seems.
That's a stark contrast to last year, wasn't it? Cat losses were much lower then.
Oh, absolutely. Just 2.9 points in Q1 2024. A very different environment.
Okay, and gross written premiums, $4.4 billion.
Yep, $4.4 billion, which, if you adjust for currency and exclude reinstatement premiums, was down about 2%, sort of similar to Q1 last year.
What really stood out to me, though, was the jump in the group attritional loss ratio, up to 62.2%.
Yeah, that's a 330 basis point increase year over year. They flagged aviation losses as one driver.
And also being deliberately conservative on loss picks in U.S. casualty.
Exactly. Part of their insurance segment strategy, seems like. But on the plus side, net investment income looked strong.
Very strong, $491 million.
Yep. You
said mostly due to higher assets under management.
That's right. More money working for them. And they also continued buying back shares.
$200 million repurchased in the quarter.
At an average price just over $348 a share. So returning capital was clearly still on the agenda.
Okay, let's maybe dive deeper into the reinsurance segment first. How did that look?
Well, gross premiums, they were down just slightly. 1.1% in constant dollars if you adjust for those reinstatement premiums.
Reinstatement premiums, those pop up after big losses, right, to restore the coverage limit.
Precisely. And they had $62 million of those this quarter versus none last year. But within reinsurance, property lines actually showed pretty strong growth.
Double digits.
Yeah, 16%, or 8% if you take out the reinstatement premiums again.
But that was offset by cuts elsewhere.
Right. They're continuing to shrink their casualty pro rata book quite significantly, down almost 22%.
And the combined ratio for reinsurance, still feeling those cats, I assume.
Oh, definitely. 103.3% for the quarter. That includes a full 18 points from catastrophe losses.
Wow, 18 points. Again, mostly California wildfires.
Primarily, yes. Compare that to 87.3% combined ratio in Q1 24, with only 2.9 points from cats. Big difference.
And you mentioned those aviation losses hit reinsurance too.
They did. Added about 2.4 points to the attritional loss ratio there. That's $61 million net of recoveries and reinstatements.
Despite that, they seem to be growing okay with Japanese clients.
Yeah, they mentioned that specifically. Attractive margins, even with programs being oversubscribed.
Interesting. And looking forward for reinsurance pricing. What's the view?
They expect sort of moderate pressure on cat pricing for the rest of 25. But they still see plenty of opportunity.
Especially in property cat, you mean, to deploy capital.
Exactly. They think the returns are still attractive there.
Okay, back to that casualty pro rata reduction. Why are they pulling back so hard there?
Well, they basically said there's just too much capacity in the market willing to write risks they don't find profitable.
And something about sticky ceding commissions.
Yeah, basically suggesting that sometimes business gets placed based on relationships rather than, optimal pricing. They feel some competitors are taking on business Everest wouldn't touch at current terms.
So they plan to keep shrinking that book unless things change.
That's the message, yes, unless the environment shifts significantly.
And stripping out those aviation losses, what did the underlying reinsurance attritional loss ratio look like?
If you exclude that 2.4 points for aviation, it would be 57.4%. Which actually suggests some underlying improvement.
Because they're shifting more towards property and being conservative on margins.
That seems to be the logic, yeah. Plus, they hinted at some favorable development coming through in property reinsurance, too.
Okay, good context. Let's switch over to the insurance segment then. Premiums there.
Relatively flat, actually. About $1.1 billion in constant dollars.
But underneath that flat number, there must have been some movement.
Oh, for sure. Property lines grew strongly, up 19%. And their specialty businesses were up 16%.
So what was the drag?
It was the third-party book, mainly driven by that ongoing remediation in the U.S. casualty portfolio. That part was down 15%.
Right, the casualty cleanup. They gave an update on that.
They did. Said about half the casualty premium up for renewal in Q1 was actually non-renewed as part of this effort.
Half? That's significant. When do they expect to be done with this?
They're targeting completion by Q4 of this year, 2025.
And the casualty business they're writing or renewing? How's the pricing?
They said rate increases averaged around 20% across commercial auto, GL, and excess umbrella.
20%. That sounds pretty strong.
Yeah, and they mentioned it's exceeding their own conservative loss trend assumptions. They see Q4 24 through Q2 25 as kind of the peak remediation period.
What about U.S. property pricing and insurance? Is that still holding up?
They said it's declining a bit from the highs, but still considered adequate.
And their international insurance business, how's that performing?
Growing strongly, apparently. Key markets, attractive loss ratios.
Yeah.
It even turned a modest profit despite ongoing investments.
Okay. What about the attritional loss ratio in the insurance segment overall?
Came in at 67.9%. They said the underlying loss ratio is improving, but that's offset a bit by the prudent risk margin they're holding.
Were there aviation losses in insurance too?
Yes, but smaller. About 0.9 points or $6 million added to the attritional loss ratio there.
And reserves in insurance. Are they feeling comfortable?
They stated they are comfortable. North American loss experience is apparently in line with their central estimates, and they've added significant risk margin to the 2025 loss picks.
Good to hear. All right, let's talk capital management. The buyback seemed like a key theme.
Definitely. That $200 million buyback in Q1, they emphasized it's a priority.
Driven by excess capital, growth, valuation.
All of the above, according to them. And they expect to continue meaningful buybacks through 2025, assuming, normal CAT activity.
Did that help the book value per share?
It did, up 3.5% from year-end 24, adjusted for dividends, and net debt leverage is slightly down too, at 15.4%.
They gave some color on the Q1 buyback volume, didn't they? Something about trading volume.
Yeah, they said the $200 million was about 2% of the average daily trading volume. They seemed comfortable with that as a start.
Especially with a shorter trading window.
Right, because of that reserve charge announcement back in January, which was material non-public info for a time.
And any hints about future buyback timing? Maybe pausing during hurricane season?
They did suggest buybacks might slow down a bit in Q3, yeah, due to hurricane season volatility.
Okay. And one other thing on capital, those Federal Home Loan Bank borrowings. Are they funding the buybacks?
No, they clarified that. It's apparently for a spread trade borrowing fixed, investing at a higher yield, not directly funding share repurchases.
Got it. Okay, shifting to the external view and guidance. Anything on tariffs impacting loss costs?
They mentioned prolonged tariffs could put modest upward pressure on loss cost trends, something they're monitoring closely.
What about the upcoming June 1st renewals, especially Florida?
They seem quite positive on Florida, expecting attractive rates, seeing increased demand, and potential growth opportunities with both local and national carriers.
And specialty lines? Still looking good.
Generally, yes, in both reinsurance and insurance. Attractive risk-adjusted returns, although they did say reinsurance is getting a bit more competitive.
Any specific specialty areas they like?
They mentioned engineering, parametric, marine, and aviation as still looking pretty good.
And primary casualty pricing, even though they're shrinking their reinsurance book there.
They think underlying primary casualty pricing is strong. Their focus in reinsurance quota share is more holistic portfolio management, not just price.
And they've walked away from a lot of casualty premium, haven't they?
Quite a bit. Around $800 million in North American casualty premium since January 2024.
Wow. Back to cat reinsurance pricing. You said moderate pressure, but returns still healthy enough.
That's their view, yeah. Healthy enough to keep deploying capital.
And the California wildfire loss.
Yeah.
Mostly in reinsurance, right? Any chance of subrogation recoveries?
Mostly reinsurance, yes. Recoveries are possible, but it's a long process, so they're not booking any credit for it now.
Would they sell those rights?
They said they might consider it depending on circumstances, but it's not the current plan.
Okay. In the insurance segment, what's the focus for new business now, especially in casualty?
It's intentionally lower volume, but higher quality. They're targeting loss-sensitive accounts, right? Industries, multiple lines of business per client.
So where is the growth coming from in insurance?
Strong growth still in North American specialty, property, accident, and health, and also across their international businesses.
Interesting. They also mentioned pulling back from European catastrophe reinsurance.
Yes, they specifically called that out. Their view is that the models and market pricing in Europe haven't quite caught up with the changing weather patterns there, frequency and severity.
But that view is specific to Europe.
Correct. They emphasize it doesn't necessarily apply globally.
And globally, any big changes expected for property cat model losses going into mid-year renewals?
It doesn't sound like it. They said no significant changes anticipated, although models are always being tweaked with new data.
How are the reserves they booked previously performing?
Performing well, apparently, exceeding their central estimate with margin building in property and other shorter tail lines.
And any changes expected to terms and conditions in property re at mid-year?
No, they expect discipline to hold there. Seems like TNCs have remained pretty strong.
So overall, the message is improving returns on capital across both segments.
That's the takeaway, driven by market opportunities and their strategic shifts in business mix.
All right, let's pivot to our This Is Not Financial Advices segment. Time for some outrageous but plausible trade ideas based on this call.
Okay, let's hear it.
So Everest sounds committed to buybacks through 2025, barring major cats, but they also flagged a potential pause in Q3 for hurricane season.
Right.
So how about this? Go long Everest stock trying to capture that buyback support, but hedge the potential Q3 volatility by buying some short-dated put options, maybe expiring just before that likely Q3 pause window.
Interesting. So capitalize on the buyback tailwind, but protect the downside during the storm season. Plausible, certainly edgy.
What have you got?
Okay, thinking about the two sides of their story. Strong international insurance growth, but ongoing U.S. casualty remediation.
Right, the cleanup continues.
So maybe long Everest stock, capturing the international growth and the expected value from the U.S. turnaround, but hedge it by shorting a different insurer, one that's heavily focused on the U.S. and maybe more exposed to those tricky casualty lines that Everest is moving away from.
A pairs trade of sorts.
Yeah.
Betting on Everest-specific strategy execution versus a more standard U.S. casualty player. I like it. Outrageous, but definitely plausible.
Tries to isolate the Everest-specific improvement story a bit.
Okay, that wraps up our deep dive into Everest Group's first quarter 2025 earnings call. We've hit the key financials, the strategic shifts, and management's outlook.
Lots of moving parts there, particularly the reinsurance versus insurance dynamics and the casualty repositioning.
Absolutely. So what are your thoughts? Do you buy into their international growth story? Will the U.S. casualty remediation deliver as planned? We'd love for you to join the conversation.
Just remember, everything we've discussed here is purely for informational purposes. It is definitely not financial advice.
I haven't said it better myself. We'll be back soon with another earnings deep dive.